Have you ever wondered what happens to the stock market after a rough year? Like when the S&P 500 takes a dive and posts negative returns. Does it just keep sinking or does it bounce back? Today, we're diving into the data to answer one big question. How likely is the S&P 500 to recover after a bad year? The numbers might surprise you. Let's get into it. Now, in the long run, the S&P 500 mostly goes up. However, bad years do happen. So, first things first, what's a bad year? We're talking about any calendar year where the S&P 500 ends in the red, meaning negative returns based on price changes. Think 2008 when it tanked nearly 40%, or 2022, with a painful 19% drop. Looking at data from 1957 to today, there have been 18 bad years. And guess what? The following year, the S&P 500 has an average gain of 14.1%. That's a solid comeback. After a year of losses, the market rallies back with double-digit gains on average. But here's the real kicker. It doesn't just recover sometimes, it recovers most of the time. Out of those 18 bad years, the next year was positive 77.8% of the time. That's nearly 8 out of 10 chances the market flips the script and ends up in the green. Some years, like after 1974's 29% drop, it roared back with a 31% gain. Others, like 2001 to 2002, weren't so lucky, but those are the exceptions, not the rule. Now, before you start throwing all your money in, a quick heads up. Past performance isn't a crystal ball. The market's got its wild side, economic crashes, pandemics, you name it. But historically, it's got a knack for dusting itself off and charging back. So, how likely is the S&P 500 to recover after a bad year? Pretty likely, about a 78% shot at a positive return, averaging 14% growth. If you're into investing, this is one stat worth knowing. What do you think? Would you bet on the market's bounce back? Drop your thoughts below, hit that like button if you learned something, and subscribe for more market breakdowns. See you in the next one.